I break analysis into two parts when I'm buying and holding real estate. I think of deal analysis in two phases. One of them, because the majority of deals that I buy are from wholesalers, the majority of deals that are coming my way from wholesalers are not deals that I would want to buy right off the bat. Either they have an HOA, which is a no-go for me. Either they're in a market that doesn't make sense for me. It's not a state that I want to invest in, or it's not, the population isn't big enough, or they don't have enough industries. So there's a lot of things that I can automatically filter out before I even ever do a deep analysis. One of the other things that I do quickly to analyze if an investment makes sense or not is I will, if it's a sub 2 deal, there's very little you can do to increase your cash flow. If it's like a low equity sub 2 deal, because you're taking over someone's existing debt. It's like if you take out a whole new loan on a property, if it doesn't get the returns that you want, there's really nothing you can do to change that loan. That's why I like seller finance, because you can renegotiate those terms and maybe adjust it to terms that make sense for you to buy, that generates you the cash flow that you want. So what you're doing is you're quickly determining, is this property cash flow positive? It's the very first thing I'm doing is this cash flow positive based on the management strategy that makes sense for this investment? Like based on the property size, based on the location, all that good stuff. If it's not even cash flow positive, I can filter that out right away, right? If it's a long-term rental, that's my plan for it, and it's losing money every month based on just the mortgage payments alone, it doesn't generate enough long-term rental income, that's not viable for me. I don't need to do a deep analysis. I already know that deal doesn't make sense for me. It doesn't matter if I can raise capital on it, if I can lower the entry, like none of that stuff matters if I'm looking for cash flowing assets, because you will never become cash flow positive in that scenario unless your rent increases. But now you're talking about a different management strategy, probably entirely. So for a long-term rental, I'm looking quickly, does the long-term rental exceed the debt payments? If that's not the case, cool, I know I can move on. For a short-term rental, for me and my specific buy box, everyone's different, but for my specific buy box, I only want to buy either A, very phenomenal properties that have tons of amenities, that house is a massive attraction, or it's in a phenomenal location that people are constantly visiting, and it's like located in a good area of that market. So if that's not the case, then there's no point for me to further analyze that as a short-term rental. I don't even need to look at the numbers. If this property is A, not in a market that I want to invest in, like it's not the location that I would want a short-term rental in, or it's not the type of property that I would want to own in that market. So that's another easy filter. And then midterm, it's not a huge thing of mine. I incorporate midterm with short-term as well. So I offer both. Typically, I'm not really doing a lot of midterm like outright. That's my only exit strategy for a property. Some people are crushing it with just doing that. But in full transparency, that's not a major focus area of mine. And then for pad split, right, rent by the room, for the most part, if I cannot have 6 bedrooms or more, it's not really a rent by the room property that I want to own. And I also only own rent by the room properties in the pad split markets. If you're not familiar with pad split, let me drop my link for pad split so that you can connect with my rep, Blake Lewis, who is phenomenal. And she can help get you educated on what is pad split, how can rent by the room make sense for you. Maybe you have some other properties that make sense for it. So, okay, so we talked about some of the quick initial filtration or like initial, filtering of deals. So for pad split, once again, if it's if I can't make 6 bedrooms, like kind of the easiest rule of thumb for me is it's in a market that I want to buy in, which is where pad split has properties, like where pad split operates in, right? So pad split is showing you these markets. They're saying, hey, we operate in all of these markets. So if I'm looking for a rent by the room, I'm not going to go to this part of Illinois or this part of Iowa. This is a huge reason why I don't really invest in rent by the room. Actually, I don't really invest much in the Northeast in general. Looks like they've expanded much more towards like this Eastern coast. For me, this is my primary spot right here. Right here is where I'm primarily buying my properties in the Southeast. Although I do own in California, I do own in Washington, I do own in Montana, and I actually own a lot in Alaska because that's where I started investing when I was in the military. Hence the Alaska military thing award that I got for my soldiers. So you can see where are they operating in. If pad split, a platform that is dedicated to rent by the room, is operating in a market, I know they have put the time and money and energy to determine that is a good market to buy in. that's similar to, or that's a good market for their strategy. Similar to, you might have heard someone say like the Chick-fil-A or the Whole Foods or the Starbucks model, where they only buy properties within a mile or two of one of those buildings, like one of those businesses. And the reason for it is because they are leveraging their market research, right? They're leveraging the market research of a Starbucks, a Chick-fil-A, a Whole Foods, and they're saying, hey, they decide to invest and build a business in this location. That means it's probably a good location for growth over the long term. So that's kind of what I do similarly with pad split. But even then, I do not own and nor do I want to own in every single pad split market. For example, I don't really own in Texas, nor do I have a major desire to. Potentially in the future, I'll buy some in certain markets of Texas. Louisiana is one of those that I just don't own in and don't really desire to. Same with Alabama. For me, it's this East Coast or like this Southeast portion, because I care about cash flow, properties generating more money each month than the expenses. And then with that goes cash on cash return. Whatever I'm investing, whatever I invest to buy the deal is justified by the monthly cash flow that I'm generating, right? So it's a cash flow and cash on cash return. It makes sense in that capacity and it benefits me that way, which is how I became financially free, was through cash flow, right? Through the cash flow generated each month. That is what covers my entire lifestyle expenses. But I also care about appreciation. Are these good markets where properties are appreciating in value, increasing in value? So do they have a lot of like great economic indicators? Are they in markets that other people are moving into? Are like places that people want to live in? Are they places that are a little bit harder to build? So one of the issues with Texas is you can just kind of build anywhere and everywhere. There's no shortage of land. And there's certain markets like Louisiana and Alabama, which are, they're good from cash flow perspective, but they don't appreciate in the same sense. So for me, between Atlanta, various parts of Georgia, North Carolina, South Carolina, and Florida, those are really solid markets for me and my buy box and what I'm looking for. Other people that I know and even help and educate, they want to buy 100 in Ohio and 100 in Alabama and whatever. Everyone's got their own goals. I'm just sharing with you my buy box. And this is a big part of it, is leveraging the data from pad split. All right, so we've talked about it on a high level. So filtering based on location, and then properties need to make sense. So I don't like to buy a property that's less than 6 bedrooms. So it's the property itself is rarely you're going to find a property that has 6 bedrooms. But for me, a good rule of thumb is 3 bedrooms, 2 bath, and at least 1750 square foot, because then I know potentially there's an office, a dining room, a living room. There's at least 3 rooms I can replace and turn them into bedrooms. Or maybe we have one in Tennessee where we've taken the whole basement and converted that into 3 bedrooms and 1 bathroom. So like I'm looking for opportunities to make more rooms out of what is already there. And it's much less costly to convert an existing room, add a few non-load bearing walls, than it is to just build a room from the very beginning. And what I really don't want to do is build too many bathrooms. Bathrooms tend to cost a lot more because you got just a lot more work. They take longer and they cost more. So having that at least 2 bathrooms is great, because a good rule of thumb is you should never have more than 4 bedrooms sharing 1 bathroom. And that's already kind of on the excessive end. So if I can at least have 2 bedrooms or 2 bathrooms and they're all shareable, I know that I can at least have 6 to 8 bedrooms, right? I really like the 3-to-1 ratio than 4-to-1, but that's a big part of it. So once the 90% of deals that I see, that's why I'm filtering them. So when you ask me how long does it take to analyze properties, 90% of them take me less than 5 minutes to analyze them and quickly filter, not a deal for me, not a deal for me, not a deal for me. And then I determine, okay, this one is not a deal for me. So if a deal makes it past the initial filtering of deals, right? It's one of the 10% that I decide, hey, I want to look into this further. I will either buy it outright once I analyze it. I will determine, you know what, I like the deal, but I need to renegotiate some of the terms to buy it. Or then I confirm, no, this is not a deal for me to buy, right? So these two are kind of the same. I'm doing the detailed analysis, which is what I showed you on the spreadsheet. I'm looking at all the different strategies for the property. I'm calculating after repair values. What is this property worth? And then what would it cost me to buy? I'm calculating rental income for all the different strategies. If it's not viable for short-term rental or mid-term rental or whatever, if it's a 3-bedroom, if it's like a 2-bedroom, 1 bath, and only works as a long-term rental, it doesn't make sense to look at it as a pad split, right? So that's one less thing to do. What I'm doing at that point is whatever strategies do make sense for it, then I'm analyzing it in full detail, getting all of my rental comps, which long-term rental between a few different tools, and I can drop links for them, the tools that I use, between those tools, or we can do a full training on that as well, outside of this Q&A, between getting all the rental income for long-term rental. It takes around 10 minutes, maybe another 10 minutes of pulling my own rental comps, right? So leveraging tools to give me a rough estimate for long-term rental income, and then 10 minutes to pull my own rental comps in that local market. So that's 20 minutes right there. Pulling up the pad split info, if it's a pad split market, it's super freaking easy because you just click on it. You see the number of bedrooms that are available, that are potential, right? If you get a layout for the property, you see the number of bedrooms. It tells you in this market, there are this many properties, this many units, and I can actually just show you that just to give you a rough idea of like how easy they make this. And I'll do one of my favorite markets, Atlanta, where we own plenty of properties. So if I zoomed in to Atlanta, right? Here's Atlanta. And then I can choose the zip code, the location that it's in. So let's choose right here, so whatever this one is. And it says, let's do one closer because I don't really buy too far out. I have plenty of mine like in near the downtown Atlanta. So let's just choose one with more properties. 281 active units, 21 upcoming units. So this is how many they currently have, how many are coming up. And then they tell me on average, each bedroom is $185 a week. If it's got a private bathroom, so I ignore this one and I look at if it's got a private bathroom, this is how much it rents for. If it's got a shared bathroom, this is how much it rents for. Average occupancy is 90%, and it takes only 2 days to get the first tenant in there. As soon as it's live, you get your first tenant within 2 days. Within the first 3 weeks, you get 80% of the property filled. This is phenomenal data. So I take these two numbers and I'll show you right here on the calculator. So all I said is a 3-bed, 2-bath, right, existing. And then we're going to add 4 bedrooms to it. We're going to convert the living room, the office, and then there's 2 more common areas or whatever. We're going to split it up at 2180 square feet. That's kind of what we're saying for this estimate. Or we can go, we'll add 3 more. All right. So $6,500 to furnish each bedroom, or to build the 3 additional bedrooms, $6,500 per bedroom, right? 6,500 times 3 is $1,950. And then to furnish the property, it's $1,500 times the 3 bedrooms here, and then the existing 3 bedrooms. So 6 bedrooms total times $1,500 is the $9,000 to furnish the bedrooms and the common areas, which for a pad split like this, I would say, yeah, that's pretty close. $10,000 to $12,000 is fairly accurate for a bedroom like this, but it depends on where is your property located. Are you setting it up yourself? Are you paying someone to set up the furnishings? All those are factors. This is just a quick rule of thumb to determine what is your total entry cost for the property, right? The cost to build it, the cost to furnish it, plus the original entry cost. This is just for a sample deal. So we can just ignore that for this instance. And then I'm going to take this data from pad split. Let's see if there we go. So 264 for a private bathroom. I'm going to say 2 of them are private. So it's 264. And then 172 for a shared bathroom. We'll go 172. This is designed for pad split in mind. That's why it's set up exactly this way. That's the tool that I utilize for managing my rent by the room properties and how I gather all my data. So the debt information is pulled from previous, like it's just made up numbers, right? It's just from whatever's on the calculator. Here's the monthly income. Here's the debt payments, the PITI, plus any HOA fees if there are any utilities or landscaping. So I estimate around $600 a month. That is so market dependent, but that's going to cover a few $100 for water, electric, gas, and trash, $100 for internet, and $100 for landscaping. Maybe you're going to add a few more things, other expenses, just add whatever that is there. Maybe we're going to say, I don't know, maybe there's a pool. Maybe there's, maybe the utilities are not enough and you change to 800. You have to figure out these numbers for your market by talking to other investors or using this as a rough estimate. That's kind of the best that you can do in that market. Just estimate. It's better to overestimate your utilities than underestimate. But you can look up quickly by just gathering some averages in a market by just searching online. Pad split property management charge. So pad split itself charges around 8 to 10%. I can't fully recall for managing for utilizing their platform to find tenants. And then you're going to still need someone to move your tenants. Like That platform is very similar to what Airbnb does. That's how tenants book your property. That's how they communicate with you. That's how payments are made. They can submit maintenance requests or messages, but you still have to manage the property. If there's a tenant that needs to move in or come in or get a property cleaned, or someone's moving out, or you have to schedule a contractor or a handyman, you still have to do that piece. So we add the extra 5% to pay for those services if and when they come up, right? Or you can self-manage it, but you want to account for your time a little bit in that scenario. Vacancy. So it said right here, vacancy, 90% average occupancy. So 100 minus 90, right? Or 10 is your vacancy. So here we change that to 10% for vacancy. And the maintenance and capital expenditures. This is money you're setting aside as reserves if and when something goes wrong on your property. So maintenance is like plumbing issues, like basic electrical stuff, whereas capital expenditures are like the bigger things that you get replaced over time. So your roof, your appliances, your flooring, right? Where your maintenance is what do you need to do to just get the property back operational. Where capital expenditures are, you're going to have to pay these costs over some point. You want to set aside the funds for that so you're not blindsided when that occurs. Depending on how new and nice your property is, this could be lower. And then, so here it'll then calculate based on your income and your expenses. Here's your cash flow, $1,449 a month. For me, I set a goal of $1,000 a month per property. And then a cash on cash return, which is this cash flow times 12, right? So it's your annual cash flow divided by how much it costs you to get into the deal, $81,827. That's 21.3% cash on cash return, right? So this is telling me based on my goal of $1,000 of cash flow and 15% cash on cash return, this is a deal based on those two. And if I said, okay, I'm going to move forward with this deal and I want to bring on a private money lender or a private money partner, well, this calculator makes it super easy. This tells you year one, if your partner is bringing we have to switch the management strategy to pad split. So you have to select that and they'll update here. If your partner's bringing the $81,000 and let's just say it's 50-50 and 0 preferred return. So this is, you guys own it, 50% your partner, 50% you, they get 50% cash flow, you get 50% cash flow. This tells you the total cash flow for the property is $17,394 for the year. Based on that, you get $8,697, and they get $8,697 for debt pay down. You guys are paying down $5,000 of debt every single month. You're paying down the mortgage. A portion goes towards principal, a portion goes towards interest. And so like that's also included, right? And the amortization schedule is telling you, here's your monthly payment, how much is going towards interest, how much is going towards principal. So it is telling you, and every single month you own a property, more and more goes towards principal. And that's what this is basically showing you. This is your monthly payment. The blue line is the principal portion of your loan, like how much of it is paying down the debt, how much of it is going towards interest. Paying down the principal is literally paying down your debt. Your tenant is paying down your debt. The interest is an interest payment, right? It's kind of wasted money, but it is also a tax benefit. So you can use that as a write-off, and your tenant's making those payments, add that write-off for you. And the longer you hold, the way amortization schedules work is the longer that you hold that debt, the more payments you're making over time, the more and more is going towards principal. And this is kind of the inversion point right here, where in this particular instance, February 1st, 2028, an equal amount is going towards principal and interest. And then after that point, more and more is going towards principal every single month. And that happens like the lower interest rate, the sooner this inversion point occurs. And so the lower the interest rate, the sooner it occurs. And the longer you hold that debt, the more that's going towards principal. So let's move on from all that and let's get back to this. So this will tell you, okay, if you do 50-50 split, you find the deal, you raise the money from a private money partner who's going to own the deal with you. Here's your guys' total returns. It's all 50-50. They get 50% of the cash flow, each 50% of the total returns of the property. So the cash flow, the debt pay down, property appreciates in value, and then the tax benefits, the 2286 of tax benefits. There's the interest payments, which are tax deductible, and then depreciation of the property, which is tax deductible. Depending on your tax bracket, this is how much tax savings you will get. And for them, if they partner with you, they get a 10.6% cash on cash return and almost a 21% return on investment. For you, because you found the deal and using none of your own money, your returns are infinite, right? You put no money in the deal. So any positive that you get is infinite returns. Doesn't mean it's necessarily worthwhile because you can have $1 and that be infinite because you put no money in the deal. So you kind of have to balance that out. That's why I make sure to set a cash flow and cash on cash return goal. But because you want to make sure, even if you're getting $1, even if it's infinite returns, you want to make sure that you're getting solid, like it's worth your time and effort to do that. All right. So I went through it in pretty good detail in regards to how long it would take me for like a pad split. Very easy with pad split. Like it's as easy as it can get. The harder part is to get a little more clear on getting your quotes. So that's why you do a rough estimate, because more often than not, you're going to have to estimate what it's going to cost to renovate the property and to furnish the property. The more you do, especially in a market, the more knowledgeable you get. And for my super investors, one of the tools that they are going to get access to are like, here's what it costs me to furnish my properties. Here's exactly the products that I buy. So you can estimate that. We might share that out to more people. I'll ask the super investors if they're cool with that. Otherwise, those are tools I'm providing to make it easier for them to analyze these deals, as well as the super creative and finance real estate investment calculator. This is exclusive to the super investors community to get a calculator like this. I do have a free one as well. Check the link in my Instagram at Michael Mnat if you'd like a copy of that free calculator. So this is the part that gets a little tough, is estimating rehab and furnishing costs. You get a pretty good idea after you do a few, and you can you could put it under contract and then get a contractor to come in, or put it under contract, the deal from a wholesaler, or send someone out even before you put it under contract to get you the quotes to build out the property. Pad Split also has referrals. So they have referrals for contractors and markets that they're operating in. That's another reason why if I'm doing rent by the room, it's in a Pad Split market, because they have all the resources that I need, or I reach out to my network of other investors. And then furnishing, fairly straightforward. The only caveat is, are you furnishing yourself, or do you need to add a few grand to get someone else to furnish it, whether it's a staging company, you hire someone on Thumbtack or whatever in that market. All right. I'm not going to go into short-term rental. There's plenty of great short-term rental analyzers out there. You can find a lot of content. You're going to do something similar to what I did with Pad Split for on AirDNA is a tool that you can leverage. And then long-term rental, we can do a whole deep dive on analyzing every single deal. But that's also what I provide you guys in my super investors community, the paid community, or even the free wealth of real estate community. We go over that kind of stuff for you. All right, let's move on to the next. Are there any questions about deal analysis? So the 90% of the deals that I'm looking at, I can filter out within minutes because they're outside of my buy box. Then I determine, is this a deal? If it's going to pass my filter, I'm going to analyze that out of the way. I'm just going to determine, is the deal that I want to buy outright? Is it a deal that I need to renegotiate? Or is it a deal that still doesn't make sense? There's no way to renegotiate to make it a good deal.